Welcome to GRE. I'm your host, Keith Weinhold. Make America rich again. In plain numbers, you'll get a fresh take today on how compound interest does not build wealth and compound leverage does. Then you'll learn about how bond market moves affect mortgage rates. Finally, you get to listen into a call between one of our investment coaches and a GRE follower today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Altoona, Pennsylvania to Saskatoon, Saskatchewan, and across 188 nations worldwide, I'm Keith Weinhold, and this is Get Rich Education, the voice of real estate investing since 2014. You're going to hear some things that you've never heard before today, and some listeners tell us that GRE is unlike any real estate information they've ever heard. And with what I want to tell you today, well, again, it's information that I've never heard anywhere else either. So what I endeavor to regularly do for you here on this show is to tell you what I wish I had known sooner. Make America rich again. Nope, that is not my presidential campaign platform for my run in the year 2032 or anything like that. It is this. Don't get your money to work for you. In fact, if you want real wealth, don't work for money or get your money to work for you. Don't make either of those things the focus anyway. Avoid growing your money through compound interest, because that's not the formula either. Now, you and I have covered that ground before. If you're new here and that material makes you say, what? You might have thought things like that were the holy grail of wealth building. Nope. And today, for the first time on the show in over 500 episodes, I'm going to put some real numbers to that to show you exactly what I mean. Let me explain to you how to invest to truly win in a way that you've never seen in your life. You're not going to improve only your life, but generationally, your entire family's life. At your job, you are like a dock worker. You're trying to pull your boat up to the dock so that you can then make a short, easy hop onto the boat and get away. And you'll learn how I did that and how I would begin investing today if I could start all over again. Now, after I had graduated college and had a job, I used to think, well, yeah, I'll invest through a 401k in mutual funds because it's easy and it's just deducted right from my paycheck. Well, when you do the easy thing in life, there's usually not much reward. And back then I thought, oh, why would I invest in real estate anyway? I mean, a stock and mutual fund return on investment is about 10% over time. Real estate is more like 5 or 6%. Plus, real estate has all these maintenance hassles. And in the stock market, your 10% return enjoys compound interest. I don't really know how that works over on the real estate side. All right, well, let's look at some numbers with how this would all work. Anyway, here we go. With $100,000 invested in stocks at 10%, after year one, it's grown to $110,000. In year two, you don't just have $120K, you've got more because the 10% compounds on the $110K. So now in year 2, you've got $121,000. And I bet that you don't see any problem in this yet, right? Hey, things are going great. And after year 3, you're up to $133,100. All right, so there we are. You begin with $100K, and after 3 years, you've got then $33,100 in profit, your gain on top of your 100K. All right, that's what compound interest does. Well, let's take a closer look at that $33,100 first, okay? I could attack it a slew of reasonable ways. If I wanted to, we could subtract out the constant drags on that of inflation, emotion, taxes, fees, and volatility. But let's just take one, volatility. We smoothed out our 10% return, saying that you achieved it every year in that example there. We know that does not happen in the real world. Stocks are volatile, and the more volatile the return, the lower the return. Because instead, if you were up 20% one year and then down 20% the next year, which stocks are known to do, you're not even, you're down. Your 100K would instead go up to 120K in year 1 and down to 96K in year 2, a loss. Like I've told you before, that right there is the difference between what's called the compounded annual growth rate and the average annual return, but we'll just leave stocks number right there. We'll say that despite all 5 drags, volatility of which is just one, the compound interest still somehow gave you this $33,100 gain. That number is about to look really disappointing, and this is about to get really interesting. Let's compare that to real estate. And we'll say that despite that it only returns, say, 6% per year here, well, how do most people buy real estate? They do it with other people's money, OPM. Remember earlier that I talked to you about how you don't create wealth from getting only your money to work for you, like you did in the stock example. Yeah, here's how you ethically use other people's money to buy real estate. When you invest $100K in a rental property, that's your 20% down. You get to borrow 80% from the bank, $400K. So now you control a $500,000 property. And here's the thing. Its entire value appreciates at 6%, all $500K, not only your $100K invested. Yes, so you're now about to get the return on both your $100K and all of the bank's money, $400K, that you get to leverage. Returns from both are about to go to you. Oh, yes. Let's run these numbers. Instead of compound interest, you're about to get compound leverage, using those borrowed funds to amplify your own return. So with your $100K invested on a $500K property at 6%, after year 1, you've got $130K. After year 2, $161,800, and after year 3, $195,508. Why? Because again, your 6% return was accumulating on the $500K property. All right, so after year 3, with this $195,508, you're going to subtract out your $100K down payment, and your gain is $95,508. All right, that is compared to your compound interest-based stock and mutual fund return of just $33,100. If you'd like to see the math for that leverage return, that is in the show notes. Look for it there. See, by employing other people's money, it's like when you were a kid and in the evening, your body cast a shadow 5 times taller than you actually were. That's how leverage allows you to magnify returns and appear to be a bigger, taller investor than you actually are. Yes, your 20% down payment on real estate gave you 5-to-1 leverage, amplifying your returns. If you listened to the show for a while, you understand that, but you never saw that numeric dollar per dollar comparison like we just did. So after 3 years, about $33K profit on stocks and $95K on real estate. Real estate returns almost 3 times as much, but in reality, it's probably more than a 3x win for real estate, because your 95K gain over 3 years in real estate equity is actually going to be higher because your tenant is also paying down your principal balance on your 400K loan every single month for 36 months in this 3-year example. If your property is vacant 10% of the time, they paid it down for you 33 out of 36 months. And as we know, at the same time, inflation pays down your loan even faster than the tenant does. Real estate is also more tax advantaged than your stock gain because you never have to pay capital gains tax on your 95K profit with a 1031 tax deferred exchange. And on the downside for real estate, upon owning the property, you will need to pay closing costs of maybe 4 to 5% of the purchase price. All right, now in this 95K gain for real estate versus 33K gain for stocks, I did some rounding there, yes. Even if your stock return was in a 401k type fund, well, you would still have to either pay the tax now with a Roth or later with a traditional retirement plan. So you're still paying the tax. The higher real estate return is also more likely because real estate is less volatile than stocks. And I've got more vitally important things to tell you about how you just grew wealth about 3 times faster with leverage than with compound interest. And yes, this is exactly the kind of stuff I wish I knew when I had just started out. Now, if you think you don't have the money for a down payment, I'll get into that. But first, a big review here, and I've woven threads of this review through previous episodes. First, don't focus on getting only your money to work for you. And second, stress compound leverage, not compound interest. Optimize using other people's money. And when you take out a loan for rental property, you get to use other people's money 3 ways at the same time. 3 different entities. You're using their money. Number 1, it's for the bank's loan like we discussed. Number 2, you're using the government's money for generous tax incentives. I only touched on one of the tax incentives. And then thirdly, you are using the tenant's money to pay down your mortgage loan and pay all of your property's operating expenses like maintenance, repairs, insurance, property taxes, and pay your property manager to make this all mostly passive for you. I don't manage any of my own properties. I think you already know that. And on top of that, hopefully you'll have a little residual income after expenses every month. Your monthly profit of rent income minus expenses, that is called cash flow. And when I talk about doing this ethically, use an experienced property manager, never get called a slumlord, provide housing that's clean, safe, affordable, and functional. Okay, some really core, enduring GRE mantras in there. But what if real estate goes down in value? It's not common, but I did have it happen to me around 2008. We won't even talk about what happens when stocks go down in value. But when real estate values went down in 2008, it just didn't matter that my rental properties' values were temporarily suppressed because my rents were higher than my expenses. I was still making income each month off the property. That's a good way to own property if you can. I'm not motivated to sell an asset. I mean, are you motivated to sell an asset that's paying you income every month during a time when its capital value dips? Probably not. And by the way, there is nothing new or esoteric here. You just haven't had it explained to you in this way before. This 33K from stocks and mutual funds versus 95K from real estate. You haven't seen that before. This is simply buying houses with plain vanilla 30-year fixed rate loans, and it's just simply long-term buy and hold. This is not flipping. As I like to say, this is not day trading, this is decade trading. As you continue along in your real estate journey, keep stacking more properties, and it's going to go faster than you think because you got this power of compound leverage, and your tenant also pays you income that you can use toward buying the next property. And then as a backup, you have that trapped equity that keeps accumulating in your property. And the reason this goes faster than you think is that you can also release that equity by removing it with a completely tax-free event, a cash-out refinance, all while you still hold on to the asset and use the untrapped equity to put down payments on more property. Now, what if you think you don't have the money to start or get as big as you want, as fast as you want? Well, I've met a lot of people that when they understand this compound leverage concept, they withdraw their 401k funds, pay a penalty, and pay the taxes, and they put those funds toward real estate. I mean, you would owe taxes on it anyway. Now, that part may or may not be right for you, but, once I understood this, what I did is I stopped contributing to my 401k, and I instead got into compound leverage. Yeah, this is how to make America rich again. Now, what if you think you don't have 100K to invest in property like we did in our example? Well, there are perfectly good $200,000 properties at GREmarketplace.com where you could make a $40,000 down payment, but you still might be thinking, just say that the real estate market is just really competitive now and that your small down payment, maybe it can't compete with a deep pockets all cash offer because all cash buyers can close really fast. But no, your small down payment can still compete with all cash offers because some sellers don't want a quick sale for either tax reasons or myriad lifestyle reasons that they might have. I like to say that using debt is like using fire. If it's misallocated, like with 23% credit card debt, that's what the average credit card interest rate is right now, 23%. Well, that can burn down your financial house. But if you know how to use the debt in a controlled manner, like from income property that others paid down for you, that fire is contained in a stove, and that fire or fireplace will heat your home. If I could start all over again with what I know now, it would be to embrace good debt because tenants pay down this debt for me, so use it as leverage to build a real estate empire. Think of it this way. Besides the employer match, every dollar that you lock inside a 401k is a dollar that you cannot use to leverage other people's money. Back when I started investing, I should not have contributed to a conventional retirement plan beyond the employer match myself. So I used leverage to pull my boat up to the dock more than 3 times faster and escape the day job when I was still young enough to enjoy it. And once you know the difference, why would you want to do life any other way? You might have heard that real estate has made more people wealthy than any other investment. Today, you've learned how. Now, sometimes it is hard to stop and turn off a mindset if the same thing has been believed for a long time. I think we've all experienced that. If you believe something for a long time, well, then it's hard to change your mind on that. And you might even fight and defend that core belief. That could be the case here with me denigrating the wealth-building capability of compound interest. And if you're still wrestling with that yourself, a great compliment where I discuss this more in depth and in a different way can be found on an episode that I did earlier this year. That is on GRE Podcast episode 507. Episode 507 is called Compound Interest is Weak. I'm here to talk to you about things that are really going to move the meter in your financial life, like what I've covered with you so far and what I'm going to help you learn next. There's just some information out there, even real estate information, that's just not that useful. Say, for example, mortgage purchase applications were down from last week, but yet they were up month over month. Well, that might matter to certain sub-industries, but it doesn't move the meter in your life with how you're going to actionably build wealth. Hey, before we move on, I want to give a major shout out to this show's long-time, steady, capable sound engineer, Bidren. He just hit the 10-year mark of filling that important role for us here. Yeah, 10 years, almost since the inception of this show. He's been with us since November of 2014, so since about episode 5, and he's edited every single episode since then, and he recently told me that he looks forward to the next 10. Congratulations, Bidren. Also, thanks to you, the listener, the follower here. We held 3 GRE live virtual events this year, webinars. You are really taking action. Back in June, we broke a record with 307 registrants for that event. And then our latest event that was held about 10 days ago saw another record broken, 528 of you registering. And I say thanks because you make me feel good. You're showing that I'm helping make a difference in your life. And now maybe you're thinking these events or this platform, it's getting too well known. And if you show up to a future event that you might not get to ask a question. No, that's not the case. Not everyone that registers shows up for the event live. And then you can ask a lot of your own questions with a personal free coaching call as well. I'll let you listen into a coaching call later on today's show, in fact. Now, I've shared with you a few times before that changes to mortgage rates don't follow changes in the federal funds rate that Jerome Powell and the FOMC said. I've also told you that mortgage rates closely track long-term bond yields. But let me tell you about what all that really means. And this is going to help you understand and perhaps even predict the future direction of mortgage rates. In fact, it's unusual. The largest market in the world is not the real estate market. It's not the stock market. It's the bond market. And what's unusual is here we are on episode 526, and we've really never discussed the bond market. Well, you're probably aware that a month and a half ago, the Fed dropped interest rates by a half point. Their next decision is in just 3 days. Now, I don't think they should drop rates again, though they could. That's because since the rate cut, GDP and job growth have been strong. That's why I don't think they should do it. I mean, rates usually get cut to help a wounded economy, so why lower them now? I mean, recessions usually see rate cuts. But here's what even fewer people understand. When the Fed cut rates a month and a half ago by a half point, why have mortgage rates soared since then? They were about 6.1%, and then the Fed made their cut, and mortgage rates recently spiked up to 6.9%. Well, many still feel that the long-term trend for all types of interest rates is lower, but for one thing, rates are really hard to predict. The Fed only controls short-term rates. Long-term rates like the 30-year and 15-year mortgage are tied most closely to the yield on the 10-year Treasury note, and hereafter I'll just call that the 10-year. All right, so what is this and what controls it? Well, don't let that name intimidate you. This is Get Rich Education, so let's break down each word. Yield on the 10-year Treasury note. Yield just means interest rate. 10 years is the period of time that this loan is made for, the duration. The U.S. Treasury issues them, so they receive the loan, and a note is an IOU, which is also known as a bond. That is what's held by the person or the entity that loaned the money. The person that loaned this money to the Treasury, it could be you, yourself, or it could be a foreign nation. So you hold on to this note because you made the loan to the Treasury. That's the breakdown of every word of the phrase, the yield on the 10-year Treasury note. Okay? So to say it a different way, if you hold a 10-year Treasury note, that is basically your receipt, your proof that you made a 10-year-long IOU to our federal government, and it is going to pay you an interest rate known as a yield. All right? That is the simplest explanation I can give. Well, a month and a half ago, when Jerome Powell cut short-term rates, the 10-year was 3.7% at that time, and at the beginning of last week, it was up to 4.2%. That's the highest since July. And again, 30-year mortgage rates most closely track the 10-year. All right, as you and I sort of hold hands through this together, next, let's ask what made them rise. And, some think this is harder to understand than trying to understand why YouTube viewers constantly fall for ludicrous housing price crash videos. Okay, but relax, this is easy. When the economy gets hot, all these things tend to rise in value. Real estate, stocks, and also productivity rises, employment rises, and inflation, that tends to rise as well. Because a 10-year investor needs a real return above the rate of inflation, this yield must rise as well. That's it. You got it? You got it. So therefore, when a rosy jobs report comes out, the 10-year tends to go up. When a strong retail sales report comes out, the 10-year yield tends to go up. Or a high-flying CPI is released, the 10-year tends to go up. And therefore, because it rose in the past month, investors have expectations for a strong economy and more persistent inflation. So conversely, expect both the yield on the 10-year Treasury note and the 30-year mortgage rate to fall when the economic outlook gets more dim. It's important to understand that, like a lot of things in the stock market, yields on the 10-year, they tend to be more of a reflection of future economic expectations than the current economy. And this should be pretty easy for you to remember because when you think about it, that makes sense. Since you've lent out your money to the federal government for 10 years, you're really interested in what that 10-year future is going to look like. So yes, though this is somewhat less exciting than watching a motorcycle jump over the Grand Canyon, now that you listened closely for the last few minutes, congratulations. Now you know that the 10-year can tell you both what investors expect to happen in the future and can tell you the direction of 30-year mortgage rates. And yeah, this is just more of the type of material that I wish someone had explained to me sooner in a way just like that. And, are you interested in doing things that at the end they make you say, you know what? I just got 1% better this week. Think about the kind of person you'll be if you make yourself just 1% better each week. Now you better understand how leverage beats compound interest and what makes mortgage rates move. Go out and vote tomorrow. As far as next, listen into one of our GRE investment coaching calls. I'm Keith Weinhold. You're listening to Get Rich Education. Hey, you can get your mortgage loans at the same place where I get mine at Ridge Lending Group, NMLS 42056. They've provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com. Your bank is getting rich off of you. The national average bank account pays less than 1% on your savings. If your money isn't making 4%, you're losing your hard-earned cash to inflation. Let the liquidity fund help you put your money to work with minimum risk. Your cash generates up to an 8% return with compound interest year in and year out instead of earning less than 1% sitting in your bank account. The minimum investment is just $25,000. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And I would know because I'm an investor too. Earn 8%, hundreds of others are. Text FAMILY to 66866. Learn more about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866.
This is Rent to Retirement's Zach Leemaster. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. There will only ever be one GRE podcast, episode 526, and you're listening to it. Let's let you listen into a coaching call between GRE Investment Coach Naresh and GRE follower Brenda, and then I'll be back to wrap it up at the end.
Hey Brenda, good to see you after emailing back and forth. Thanks for setting up this call.
Yeah, thanks, Naresh. Thanks for setting up time to talk to me.
Yeah, well, tell me, what made you schedule this call? Like, why did you hit that button saying I want to talk to the real estate investment coach?
Yeah, well, I've seen some of the newsletters that come from GRE. I'm familiar with some of the podcasts, but then I had gotten into the newsletters, and then I saw that there was an option for a free consultation to talk to you. And I thought, well, I'm not sure what this really means or what we talk about or how you can help me as far as like the vision or how do I set my goals or what is it exactly that I would do with you with GRE? Like, what kind of consultation do you provide?
Yeah, well, so that's you came to the right place. So let me tell you a little bit about GRE, a little bit about me, who we are, how we operate. So Get Rich Education is an education company. As you know, you listen to the podcast, you read the newsletter, it's free. The podcast is free, the newsletter is free. You can go to our website, read our blog, go through past podcasts. You can subscribe to our YouTube channel, subscribe to our social media, TikTok, Instagram, Facebook, X, you name it. That's all free content available for you. And this service, the real estate investment coaching, is completely free of charge. I know that sounds kind of crazy, but you'll never pay us a dime. I'm here to help you throughout and along your real estate investment journey. Think of me as a super connector, someone who can introduce you to all the right people, whether it's specific markets you want to invest in, providers there, wholesalers, flippers, lenders, appraisers, although your lender will take care of the appraiser part. If you need a second lender, financing, CPAs, attorneys, anything at all, just come to me and I can introduce you to the right people or at least point you in the right direction. I'll try my best to do it 100% of the time. I don't have answers 100% of the time, but I do have answers most of the time, and I can forward you and refer you, point you in the right direction. So think of me as a super connector. Think of me as your silent partner in deals who does not get any equity in the deals, who you don't have to pay anything to. Think of me as an advisor, a consultant. Again, this is a completely free service. You're not going to get like a bill in the mail saying, hey, you talked to Naresh 5 times, so you owe us $1,000 for that. No, there's none of that. So the most common question I get after telling people this are like, well, then, I mean, you can't be doing this for free. Like, why are you doing
Right.
it? Like,
Yeah.
What's the catch here? And they also have, I mean, I'm sure you're wondering, how do you make money? Well, if you listen to the podcast, if you go to our website, you'll see advertisements, sponsorships. We are paid marketing fees, advertising fees from partners. So you listen to the podcast, I'm sure you hear many of those commercials. We make our money on the back end so we can keep services like this and our newsletter and our podcast free on the front end. Like I said, GRE is an education company. We are not a broker or a wholesaler or a flipper or a builder or an agency or a realtor service or any of that. A brokerage, we're none of that. We're purely education based through our educational content, through our free educational coaching, which I offer too. So that's what GRE.
Got it.
We work with all those other companies, so we can refer you to all those other types of companies that can help you on your real estate investment journey, but we are not any of those. Now, me personally, I am an investor myself. I own 8 properties in the southeastern United States. I got started in 2017. I bought my first property, a single family home that was rehab. Back then, rehabs were very hot. That was what you should get in, what made sense to get into. And I scaled pretty quickly. I went from 1 to 8 in a matter of, it's been 7 years since I bought that first property, but I actually went from 1 to 8 in a matter of more like 2.5 years. I just kind of went.
Oh, wow.
So I bought, like I said, southeastern United States, bought my last property in 2020. I'm saving up for my next property because I personally now only like new construction. Rehabs have their place certainly for certain investors. And at the time, I got 6 rehab properties from 2017 to 2019. So I personally, though, am now saving up because new construction is more expensive than rehab. So I'm saving up for my next real estate property, which is most likely going to be a new construction. So that's a little bit about my investing background. I've been a real estate coach since 2019, came in 2021 to GRE and have run the coaching side ever since. So that's a little bit about me on the real estate side, on the coaching side. Now, my background is not in real estate. Like I said, I got in 2017 before that, and I still do work in tech. So I worked in tech from 2005 and still do work in tech. So it was through my tech work that I got involved in real estate, because I would do back-end tech work for real estate companies. And doing that work, I was like, I started learning about real estate. And then I said, if this doesn't seem that hard or difficult. And I also got an investment coach who helped me. Like I said, with that competitor, they also had investment coaches or investment counselors. So I had a coach who helped me a little bit, but that's what the coaches are for. They're to help investors like me, especially newbie investors or even veteran investors. They're there to help investors with the networking part, with the who are offering the best deals, special interest rates, who's honest, who's dishonest. That's what I'm here to do. So that's a little bit about GRE, about me, about my background, how our coaching program works. So now, Brenda, it's all about you. I want to hear, I'm sure you have tons of questions based on what I just said. But before you ask those questions, I'm just going to start out with, how much cash do you have ready to invest? Because really, I could be of most service if you're looking to invest. Otherwise, I can't really be of much service. So how much cash do you have ready to go to invest? And then I'll say something about that, and then I'll let you ask whatever questions you want.
Sounds good. Just a cash ready for deployment is 100,000, but I'm assuming that doesn't all have to go to one property, right? Or depending on the property?
Yeah. So is that so what I should have clarified my question as, how much liquid cash do you have on, not like a 401k or properties that you have to cash out, refinance, or just if you were to take a property and you had cash ready to, so it'd be $100,000.
Yeah.
Okay.
Correct. Yeah.
Okay. So a few things. That's very good, because with 100,000, that gives you optionality. You can either go for a rehabbed property, and we have rehab property right now. Our hottest provider is in Memphis, Tennessee, and you can get a rehab property. Worst case scenario, let's just say the average property is about $100,000, and so you just put down a 25% down payment. So let's just give or take, let's say $30,000. I tell our investors, I say, look, if you want to buy your first property your first rehab property, you need at least $50,000 cash liquid in the bank ready to go. That's just because you want that cushion. You don't want to put all your eggs in one basket. So I say, if you want a rehab property, you need $50,000. If you want a new construction, single family, $100,000, because the new constructions are going to cost you at least $240,000. At least. So if you take 25% of that plus closing costs and cushion and everything, just if you want to be a good investor, you have to be disciplined, and you have to be disciplined enough to be able to save the $50,000 or the $100,000 if you want to make it as a real estate investor. So $50,000 for a rehab property, $100,000 for a new construction. If you want a duplex, you need, I say, a new construction duplex, which is probably our hottest new construction asset class right now in Florida. $150,000 for a new construction down payment, or not down payment, cash ready to go for a new construction duplex, because those are selling for about $490,000, give or take. So it's $50,000 for rehab that you should have in the bank, $100,000 you want in the bank for a new construction single family, $150,000 for a duplex. Anything beyond that, then we can talk, later. You want a quad or something else, but that's generally what I say. And I tell investors, I say, look, if you only have $30,000 in the bank, let's connect after you get up to the 50, because I don't want you putting all that $30,000 into a rehabbed property where, who knows, maybe the economy might go into a recession and it stays vacant for 6 months. I don't want you to have to go through that. So let's stick to those numbers. So you said you have 100,000, so you have options. You can get either a rehab property, or you can get a new construction. So it's completely up to you. It's about a new construction, single family. It's completely up to you. I personally, like I said, I started out with the rehabs, and then I kind of graduated up to new construction. I think the lowest risk you can take with 100,000 is by starting with just a low price rehab where you put in $30,000 in full, down payment, closing costs, everything else. You put that, 30 grand. If it's your first property, you put that 25 to 30 grand in, and you treat that as a learning experience, and you go through the experience. And if everything goes smoothly, then you can buy the second property, and you can decide whether, hey, do I want to continue with this rehab, or I still have enough capital for the new construction single family. But I would start small if you're new. If you're an advanced veteran investor who has well into the six figures in the bank ready to go, I tell those people, I say, hey, let's just go for new construction. Let's go for the new construction single family. Let's go for the duplexes. Some of them have $700,000, $800,000, in some cases $1 million plus. I say, hey, let's just go for the quad new construction fourplex. The incentives are great, et cetera, et cetera. So in your case, 100,000, you certainly have choices. And what I'll do after this call is, well, first I want to hear, based on what I said, what are your thoughts on anything, whether it's the new construction versus rehab, and then what I brought up earlier about coaching?
Yeah, I actually, thank you, Naresh. I really like what you said about starting small. I have purchased two single family homes in the past. They're rentals, but I never went through a coach. I just kind of did it on my own, and luckily things worked out. But certainly having a coach and starting out small just to kind of go through the process is really helpful. Here's the situation that I think is just a little bit different. And I know that this would probably be something that I'd talk to like a lender about. But in your experience, I actually just came from an 18-year career. Actually, I was in tech myself. But I'm now transitioned from a corporate W-2 into more of a 1099, what's classified as like a independent company, type of income. What has been your experience with other clients that transitioned from that type? Is it easier? Is it harder to obtain loans? Is there going to be different requirements? 25%, does that still stand?
Yeah, so I could give you a full lecture on this. There's something called the housing expense ratio and something called the total obligation ratio. I'm not going to get into those details because the lenders, I can refer you to lenders and they can explain all that. And those ratios mean a lot to getting you pre-qualified. But what I will say is, unfortunately, if you are 1099, you are at a disadvantage because it's not steady, consistent income. Unless you can show 2 years of steady, consistent income, I mean, really is, they'll last for your last 2 years of tax return. So if it's a new 1099 gig,
yep,
you're going to have to wait until you have 2 years of consistent high income. If you've been doing it for a while, then send your last 2 years. And if it's, if it's looking good, then you'll get approved. The other option, and this is not a personal question or anything, but if married couples can go together on one loan. So if this actually helped me out a lot because my wife is a high income earner and I have my own business and my business does pretty well. But if you're 1099, as you know, there are all sorts of things you can do with your tax return that are completely legal and to where you pay yourself as little as possible so that you can cut your income tax. So in any case, that's why 1099 workers are a disadvantage for a mortgage because all they care about is your pay stub, your, how much income did you have? So there were times when I put my wife on the mortgage and she's got a high income. And so you can put a spouse on there and you can both do it together. Now, you're allowed 10 loans per person. So if you and a spouse go on a mortgage, that counts, even if it's for one mortgage, one property, that counts as one for each of you. So for two working husband and wife, for a couple where both spouses are working with good income, I say, look, you'll want one spouse to do 10 properties and another spouse to do a completely different 10 mortgages. That way you can do 20 combined. Now, if you do it together, then you'll only be able to buy 10 combined because you're only allowed 10. So 1099 workers, we get that question a lot, and it is a problem because the standards changed after 2008. So either wait the 2 years and have your consistent records to show high income, or if you already have it right now, then you can get approved.
Got it. Got it. This would be for just conventional loans. What about other loan products? Like, I think I've heard of the DSCR loan, where maybe just the rental property would cover, part of I'm not sure. Like, I guess you're guaranteeing that the property will make enough money to cover the payment of the loan.
Yeah, DSCR loans are hard to get approved. Really, what I should do is introduce you to some of our lending partners if you're interested. DSCR is meant more so for people who have utilized, you want to use those 10 loans first. So,
okay.
Because if you go, you're going to have a higher interest rate if you go with the So those DSCR loans or portfolio loans are meant for people who have used their 10, their spouse has used their 10, they've got cash flow rolling in, they're ultra high net worth. So they're fine. Okay, just get me another loan. I need the tax benefit. I need the tax break. I'm fine paying a 10% interest. So they'll go for a portfolio loan or a DSCR loan. In your case, it's your first property, your first investment property, first turnkey. We want to go for a loan.
Got it. Makes sense. And then another question. So this was about the financing, but another question that I meant to ask earlier is, I know you mentioned I'm not like a realtor or anything like that, but how does it work? Like, I think about when I'm purchasing a home personally, I kind of say, hey, I want 3 bedrooms, 4 bedrooms, this many baths. Like, how does that work with you? Like, do I give you criteria of what I'm looking for? Or, based on my goals, do you kind of craft a plan? How does that work?
Yeah, so I actually sent you an email just right before this call. I think you got the email, and it includes a link to about 20% of our inventory. It's not all of our inventory. That inventory is just there to get you started to see the types of properties that we have available, rehabs, new constructions, and the markets that we cover. Again, it's only about 20% of the inventory. If you go to our GRE marketplace, you can see all of the markets that we cover. Your biggest source will be, I send out emails. So your biggest source will be, if I email you, I'll email you like a property. It'll be, hey, I just came across this deal. It's my VIP email list. So you'll get my, VIP emails, and that's going to be your best source. You also get Keith Weinhold's newsletter, which promotes properties from time to time. And we only promote the best. There are hundreds of properties we can promote. We only distill it down to the best of the best. So don't think, there might be another property that Naresh knows about. No, we promote through our social media, through my email list, through Keith's newsletter, through the podcast, through the webinars, the best of the best. So that's the best way to find out.
Got it. Your inventory or what you currently...
Right. And with your permission, I can add you to my VIP email list if it's okay.
Yeah, that would be great.
I'll go ahead and add you, and you'll start getting those emails in real time. I only send out an email maybe once every 3 weeks. So I really only want to send the best of the best. I don't want to waste people's time.
Great. So what if you do send me an email and I'm like, yeah, I love it. I think fits exactly what I'm looking for. Do I email you back? Do I contact you? Like, how do we stay in contact?
So email is the best form of communication, because in real estate and business in general, we want documentation of everything. We don't want any miscommunications. So if you see something you like, email me. I'm available. You have my phone number. You can text me. You can call me. You can email me. I'm very accessible, but email is preferred, because that way it's in writing and I'll know exactly what you want, the address, everything. So let's say you see a property that you like from an email that you get from Keith or from me, and you email me and say, hey, I'm interested. What are next steps? I will get you in touch with the actual, like I said, we're just an education company. I'll get you in touch with the actual builder or the broker or the agent on the property, and they'll be able to answer way more questions than I can answer, way more. And that's for anything. If your question is about financing, I can get you in touch with several good low rate lenders, and they can answer all your questions about financing. If your question is CPA tax stuff, we have several good contacts who can help you out there as well.
Got it. So then what does our communication look like from there? Like, if I say, yes, I want it, then you get me in contact with them, and then I kind of work with whoever it is that has this property, and then hopefully we just close on the property and that's it, right? Am I understanding?
So I'll refer you over to them, and they will take care of you. You should copy me on all emails. That way, what's going on? Copy me. Remember, I'm your coach. I'm here to help you. Like, it's free. So copy me on email so I know what's going on. If there's a problem, I can jump in. In many cases, I hold leverage over a lot of these people. If a problem happens, I can step in and say, hey, treat her better, or, you should waive this cost or whatnot. So copy, because the people who get into trouble are the people who didn't copy me on the emails, and many time just goes by, and then they come with their problem. I say, hey, if you came to me a year ago, I could have actually helped you with this. Now the statute's expired and it's a complete mess. So always, even after you're done closing on the property and you have a tenant in there, and just copy me on the email.
Got it. Okay. So kind of bring you along the journey. Okay. So let's say I'm at the end. Like, do these providers help me? I'm assuming in some of these cases, you've mentioned places that are far from where I live. So do they help provide additional resources, like who's going to manage my property or who's going to find me a tenant? Like, could they help me with that?
Absolutely. So the entire point of GRE, of this investment coaching program, the entire point is so that you can become what's called a laptop landlord. You can literally live free and just take a step back and have your properties run on their own. So the idea is not for you to invest down the street and become a property manager and a landlord down the street. You can be anywhere in the world, buy properties anywhere. Like I said, I live in Florida, but I've never visited any of my properties. I've never met a tenant. So that's what you want to do, and that's what we help people do. If you want to buy a property across the street and you can do that yourself, go through all the hoops yourself. We are here to help you invest in Ohio, in Tennessee, in Florida, in Texas, and all these places that you may not have even visited ever in your life, but you can still have a very fruitful investment journey. So we set all that up for you. The property management, all that, it's going to be taken care of so that you're hands off. That's why it's called turnkey real estate investing.
Got it. Okay. Sounds good. And typically, how long does this process take? I mean, I'm sure it's different for everybody, but what can I expect? Like from when I talk to you to when hopefully I have a property that I'm signing off on?
In some cases, it's literally taken 2 days. In other cases, there's not even an answer because people didn't end up buying.
Okay.
Yeah. So yeah, in the case of like our Memphis Burr properties, which are rehab properties in Memphis, I recommend that you watch our Burr webinar. I can send that to you after this call if you'd like. But I had people who watched the webinar, talk to me. I introduced them that same day to the provider in Memphis. They talked to the provider in Memphis, and then the next day they picked the property, and the day after that they signed a contract.
Oh, wow. Okay.
So it's all about the investor. If you're a serious investor, it can be very quick. Like me, I was very serious. That's why I scaled. I bought 8 properties in 2.5 years. Other people, if you want to take your time, you could literally take your time and never buy anything. And a lot of people are doing that now because in 2019, they said, oh, you know what? I'm going to wait. There's going to be a crash and this and that. And so they waited, and prices skyrocketed. And now they said, you know what? I'm priced out of the market. So I'm just not going to invest in real estate anymore.
Yeah, it's that analysis paralysis. I've experienced that. Yeah. Got it. Okay, cool.
All right. So any other questions?
No, this is really helpful. It's kind of good to know, like, kind of where you step in and kind of where you hand off. And again, the timeline is different for everybody, but it's kind of good to know that I could literally be standing here 2 days later and have a property if I want. So good.
Yeah. So as we end this call, next step. So I told you about new construction versus rehab. Are you interested in both or leaning towards one or the other right now? Just tell me.
Probably the rehabs, because I think like what you said, I like the idea of a baby step into like, let me see how this process goes first before kind of committing a bigger chunk of capital to something larger. Yeah.
I agree. That. Okay, so here's what I'm going to do as next steps. I'm going to send you a link to the webinar we did for our hottest rehab asset class right now, hottest rehab provider out of Memphis. It's the Memphis Burr Key webinar. I went ahead and just emailed that to you. So watch that webinar. It will answer like every question imaginable regarding the provider, how they do their process, the properties, everything. So watch that webinar and then shoot me an email after you're done with the webinar on what you're thinking. Just, you can watch a webinar today, and if you want to shoot me an email right after, just let me know what you're thinking, and we can go from there. I think that's would be the next step. Just watch that webinar and then we'll reconnect.
Sounds good. Okay. I like that.
Okay, very good. Well, I sent that link to you, and that's about it. If you have no more questions, like I said, you can add my phone number to your phone book and feel free to reach out whenever you want.
Will do. Thank you so much.
All right, thank you. It was great.
Yeah, I hope that you found that helpful in making America rich again, namely you. Of course, no two coaching calls are the same. Some GRE followers will perhaps have more questions than Brenda did there. We are here to learn your situation. We know the mistakes you've got to avoid, and we can connect you with the best income property for you across the nation. We really filter it down to the best of the best. And besides being a truly free coaching call, we don't try to upsell you to a paid course or anything like that, because we don't even have any product to sell, really. So even if you wanted to buy something from GRE, I don't know if you could, maybe unless you buy a GRE logo t-shirt from our website or something like that. So keep all of your funds for the property down payment. As far as now, you can book a coaching call at gremarketplace.com and select the free investment coaching area. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.